When I first saw the headline about Meta spending over $1 billion to buy a Chinese AI startup, my initial reaction wasn't surprise at the price tag. I asked myself, what does Mark Zuckerberg know that the rest of Silicon Valley is only now beginning to panic about? And more importantly, what does this single deal tell us about the entire trillion-dollar AI race that the United States is supposed to be winning? Here's what I've been piecing together. And I gotta say, the picture looks very different from what most headlines are telling you. We're looking at a fundamental shift in the artificial intelligence landscape, one that has less to do with who has the flashiest chatbot and everything to do with who can actually turn AI into money, scale, and real-world power. Before we dive deep into the strategic implications, I need to state clearly that this video is an educational and analytical discussion of geopolitical and economic events. It reflects my own analysis and opinion based on publicly available information. This does not promote violence, hate, or extremist ideologies. I'm sharing how I think through these issues, not telling anyone what they should do. Okay, so here's what's happening. Last year, the United States went all in on artificial intelligence infrastructure at a scale that's honestly hard to wrap your head around. We're talking about the big tech players, Google, Amazon, Microsoft, Meta, dropping a record $61 billion just on data centers alone, and that was just the beginning. Goldman Sachs tracking shows total AI investments hit $400 billion in 2025. Now they've revised their 2026 forecast up to nearly $530 billion. The numbers are so large they start to lose meaning. But here's the part that caught my attention, and I think it's the most important piece that nobody's really drilling into. All this spending is happening at the exact moment the United States is facing a brutal funding crunch. The U.S. Treasury has to refinance $8 trillion worth of debt this year. That's $8 trillion in bonds that need to find buyers at a time when interest rates aren't getting any cheaper. This isn't theoretical. It means a tsunami of bond issuance is about to hit the market, draining liquidity that might otherwise flow into corporate borrowing for these massive AI projects. And it's not just the U.S. doing this. China is also pulling huge amounts of capital into its own AI sector. Chinese tech giants like Tencent and Alibaba are planning to invest at least $70 billion this year alone. But there's a crucial difference, and this is where the strategic picture starts to shift. China has two things the U.S. increasingly doesn't have in abundance: cheap power and the physical ability to scale data centers rapidly. Chinese power demand for data centers jumped 25% last year, and it's accelerating. They can build infrastructure at a pace that looks almost impossible from a Western regulatory perspective. Now, what does all this money actually buy you? That's where the story gets really interesting. The United States has built an incredible number of AI models. We have frontier models coming out of OpenAI, Google, Anthropic, and others. But there's a massive gap between having a powerful model and having a profitable application. This is what I call the monetization gap, and it's becoming impossible to ignore. U.S. tech companies have lost an average of 35% of their market cap value recently. 61% of public tech companies are down by a quarter or more. Meta itself dropped 17% from its high, wiping out $340 billion in value. Global investors are no longer rewarding capital expenditure on AI for its own sake. They want to see actual revenue. This brings me to what I think is the most telling event in this whole story. Meta, Facebook's parent company, just acquired a Chinese-founded AI platform for over $1 billion. The company is called Manus AI. Zuckerberg didn't buy this company because he wants to add to his collection of AI research papers. He bought it because this startup has something Meta desperately needs: a working AI agent product with actual paying customers. Let me explain what an AI agent is, because this is key to understanding the whole strategic shift. An AI agent isn't just a chatbot that answers questions. It's an autonomous system that can complete multi-step tasks. You tell it to plan a vacation, and it books the flights, reserves the hotels, arranges the transportation, and handles the itinerary without you micromanaging each step. Commercially, companies are using these agents for HR workflows, data analysis, supply chain management. Manus AI has paying customers generating real cash flow today. It has three advantages that Meta cannot ignore: cost efficiency baked into its DNA from operating in China, immediate revenue generation, and complete independence from Meta's competitors like OpenAI, Microsoft, or Google. While all this is unfolding in AI, another trillion-dollar market is experiencing a parallel shift. China's BYD has overtaken Tesla as the world's largest electric vehicle maker. In the fourth quarter of last year, BYD sold 25% more EVs than Tesla. This is happening despite heavy tariffs and market restrictions in the US and Europe. In China itself, which represents over half of global EV consumption, BYD is absolutely dominating. Their Seagull model sells for less than $10,000, undercutting Tesla's cheapest offering by more than half. The BYD Seal, a direct Model 3 competitor, is up to $7,000 cheaper. During my visit to Singapore, Malaysia, and the Philippines in December 2025, the number of BYD cars on the roads was noticeably higher. People want to save money, but they also want modern technology. Tesla simply can't compete on price in China right now. Elon Musk has been slashing prices, offering 8,000 RMB in free paint options, which is about a $1,200 discount at most, plus a 5-year zero-interest financing. But Chinese interest rates are already so low that this saves consumers only a couple $1,000s. BYD can match or beat these offers while maintaining profit margins because their cost structure is fundamentally different. The thing that makes me think Tesla is in serious long-term trouble in China is what I call the data dilemma. Chinese law requires driving data to be stored and processed locally. You can't just export it overseas for AI model training. The logical solution would be to train Tesla's full self-driving system on Chinese servers inside China. But US government restrictions prohibit large-scale AI model training in China. So Tesla is caught in a geopolitical vice. They can't effectively train their FSD system on Chinese driving data, which means they can't improve it for Chinese conditions. Meanwhile, BYD has integrated DeepSeek AI to offer their God-Eye self-driving system, and early reports suggest it may already be better than Tesla's FSD in Chinese conditions. This is a perfect example of what I see as the bigger theme here. U.S. restrictions on technology transfer to China were designed to slow Chinese progress. Instead, they're creating choke points that handicap American companies in the world's largest market while accelerating Chinese innovation. DeepSeek, which I think of as China's Sputnik moment in AI, emerged precisely because Chinese developers couldn't access NVIDIA's most advanced chips. They had to invent software optimizations to make their models run efficiently on less advanced hardware. Now they've published research showing how to reduce computational and energy demands for training AI systems. This isn't just a technical curiosity. It means Chinese AI models can run on commodity hardware with lower power consumption, which undercuts the entire US semiconductor advantage. Now, before we dive deeper into this high-stakes tech competition, I want to quickly mention something that's been a genuine help in my own routine. I've been using Mom's Meals lately because, like these tech companies trying to optimize their operations, I'm looking for solutions that just work without me having to manage every detail. Mom's Meals delivers chef-prepared, ready-to-eat, healthy meals right to your door. What I really appreciate is the range of options. They have keto-friendly meals, diabetic-friendly, low-carb, low-cholesterol, halal, vegetarian meals, and so much more. Everything is designed for real convenience and nutrition, which fits perfectly into a busy schedule. The best part? Prices start from just $7.99 per meal. If you're interested in trying it out and saving some serious time, I've put the link in the description. You can get 50% off your first order if you want to try it. All right, let's get back to the core question that's been bothering me since I started connecting these dots. Why is Meta, one of the richest companies in the world, so desperate that it has to buy a Chinese AI startup to stay competitive? And what does this tell us about the underlying health of the US AI ecosystem? From my perspective, what we're witnessing is a classic case of overinvestment in infrastructure without clear pathways to monetization. The United States has built the digital equivalent of a high-speed rail network, but we haven't figured out where the trains are supposed to go or who's going to buy tickets. We have these massive, expensive frontier models that can write poetry and pass law exams, but the commercial applications are still limited. How many $20 or $50 monthly subscriptions can the market actually support? There's a ceiling, and I think we're hitting it. This brings me to what I consider the most overlooked strategic insight in this whole situation. The US tech industry has bet heavily on the idea that AI models themselves would be the moat, that owning the most advanced algorithms would guarantee market dominance. But what if that assumption is wrong? What if AI models, these frontier algorithms, are becoming commoditized? If everyone eventually has access to models that are good enough and the real value shifts to the applications built on top of them, then the entire US strategy needs to be rethought. This is exactly what Chinese companies have understood from the beginning. While US firms were racing to build bigger and more powerful general models, Chinese firms were focused on practical, deployable applications that solve specific business problems. The Chinese-founded AI platform that Meta acquired didn't succeed because it had the most advanced underlying model. It succeeded because it built a product that companies could actually use and would actually pay for. It had real customers, real workflows, and real cash flow. That's becoming increasingly rare in the US AI landscape, where demos and research papers sometimes seem to count for more than revenue. I want to address a counter-argument here because I think it's important to show where I could be wrong. Some analysts I respect have argued that US sanctions will eventually work, that by cutting off China's access to advanced chips and capital markets, we're setting up a situation where Chinese AI development will hit a wall. They point to the fact that China's most advanced chip maker, SEMIC, is still several generations behind TSMC and Intel. They argue that while China can make incremental progress, they can't make the leap to true frontier AI without Western technology. But here's why I'm less convinced. First, DeepSeek already proved that software innovation can compensate for hardware limitations. If you can't get the most advanced chips, you figure out how to do more with less. That's a powerful incentive for innovation. Second, the Chinese market is so large that domestic demand alone can support massive R&D investment. We're talking about 1 billion+ consumers and state-directed capital allocation that doesn't need to worry about quarterly earnings calls. Third, and this is crucial, every restriction the US places creates a stronger incentive for China to develop indigenous alternatives. The history of technology sanctions shows they often accelerate domestic capabilities rather than retard them. Another angle I think is underappreciated is the energy dimension. Power consumption for these data centers is becoming a critical constraint. In the US, we're trying to build massive AI clusters while also dealing with grid capacity issues, environmental regulations, and local opposition to new power plants. China, for all its pollution problems, can direct national resources toward power generation in a way that our market-based system struggles to match. They have the political will and centralized control to scale up electricity production specifically for AI data centers. This isn't just about cheap power today, it's about guaranteed power availability tomorrow. The Meta acquisition is particularly telling because it shows the depth of the monetization problem. Zuckerberg isn't just buying technology, he's buying a business model. He sees that US hyperscalers have invested hundreds of billions in infrastructure, but haven't cracked the code on turning that into sustainable revenue streams. Chinese-founded companies operating in a hyper-competitive domestic market where profitability matters from day one have been forced to develop lean, efficient, customer-focused products. In a way, Meta is acknowledging that the Chinese approach to AI commercialization is superior to the Silicon Valley approach of build it first, figure out monetization later. What strikes me about this is how it reverses the historical narrative. For decades, the US was the place where garage startups built practical products and scaled them globally. China was seen as the copycat, the factory floor, not the innovation hub. Now we're seeing a Chinese-founded AI company teach Meta, one of the most sophisticated tech firms in history, how to commercialize AI agents. That's a remarkable shift. Let me connect this to the Tesla story because I think they share the same root cause. Tesla is losing in China not because their technology is inferior in some absolute sense, but because they can't adapt to local market conditions. They're trapped between US government restrictions and Chinese regulatory requirements. The data dilemma I mentioned earlier is a perfect microcosm of the broader problem. American companies are being squeezed by their own government's geopolitical strategy, which may be well-intentioned from a national security perspective, but is handicapping them commercially. BYD's success isn't just about cheaper labor or government subsidies, though those help. It's about understanding that the Chinese consumer market is fundamentally different. Chinese car buyers are incredibly discerning because they have so many domestic choices. It's not a tariff-protected market like the US, where a few brands can dominate. In China, you have dozens of EV manufacturers competing on price, features, and technology. The best product wins. BYD figured out how to make EVs that are good enough and cheap enough to appeal to the mass market. Tesla is still trying to sell premium vehicles in a market that wants mass market transportation. This is where the US-China tech war gets really complicated. Washington's strategy assumes that restricting technology flow will maintain American advantage. But what if it actually creates protected markets where Chinese companies can perfect their products without American competition, then export those products globally? We're seeing this in EVs. We're starting to see it in AI applications. The restrictions may be creating a parallel innovation ecosystem that doesn't depend on Western technology and is therefore immune to Western pressure. Now let's zoom out and think about what this means for the global technology landscape over the next 5 to 10 years. Because what I'm seeing isn't just a couple of isolated incidents. It's a pattern that suggests a fundamental reordering of how technology gets commercialized and who profits from it. First, consider the capital markets. The U.S. has been able to fund massive tech investments through deep, liquid capital markets that are the envy of the world. But that system depends on investor confidence that there will eventually be returns. If U.S. tech companies can't show clear paths to monetization, that confidence erodes. We're already seeing it in the 35% average drop in market cap across the sector. If that continues, the funding spigot starts to close. Companies can't borrow as cheaply, stock-based compensation becomes less attractive for hiring, and the whole ecosystem slows down. Meanwhile, Chinese companies have access to state-directed capital in domestic markets that prioritize strategic positioning over quarterly profits. This creates a different kind of moat, not technological, but structural. Chinese AI firms can afford to play the long game in a way that U.S. public companies increasingly cannot. This divergence in capital availability could become self-reinforcing, where Chinese firms pull further ahead in applications while U.S. firms get stuck in a cycle of cutting costs to please Wall Street. Second, there's the talent question. For years, the U.S. has been a magnet for global AI talent. But as Chinese companies develop more sophisticated applications and offer competitive salaries, and as visa restrictions and anti-immigrant sentiment make the U.S. less welcoming, we could see a talent shift. Chinese researchers and engineers who would have stayed in the U.S. might return home. International students might choose Chinese universities over American ones. The network effects that have concentrated AI talent in Silicon Valley could start to weaken. Third, and this is where it gets really consequential, we're looking at the potential fragmentation of the global technology stack. If Chinese AI models become optimized for less advanced chips, and if Chinese semiconductor manufacturing continues to advance even at a slower pace, we could end up with two separate technology ecosystems, one based on Western chips and AI models, another based on Chinese hardware and software. This would be hugely inefficient for the global economy, but it's looking increasingly likely. The energy dimension is another second-order effect that doesn't get enough attention. Training large AI models requires enormous amounts of electricity. In the US, we're struggling to build new power generation fast enough. There are debates about whether to use natural gas, nuclear, renewables, and how to balance grid stability with AI power demands. This creates uncertainty and delays. China, by contrast, can simply decree that new power plants will be built and that they will serve AI data centers. The environmental costs are real, but the strategic advantage in the short-term AI race is undeniable. I also think we need to consider what this means for U.S. allies and partners. Countries in Europe, Southeast Asia, Latin America, they want access to AI technology, but they don't want to be forced to choose between the U.S. and China. If Chinese AI applications are cheaper, more efficient, and better suited to their needs, they'll use them. The U.S. risks losing influence not through military defeat, but through commercial irrelevance. I see this happening already in EVs, where even European countries with tariffs are still buying BYD vehicles because the value proposition is too strong to ignore. The financial system implications are another layer to this. The US dollar's status as the world's reserve currency has been supported by the fact that the deepest, most innovative companies trade in dollars. If the center of tech innovation shifts even partially toward China, that could accelerate de-dollarization trends, especially in technology trade. Companies might start invoicing in yuan for AI services or using alternative payment systems to avoid US sanctions risk. This is a very slow-moving trend, but these tech shifts could accelerate it. In the US, we've built an economy where a small number of tech giants drive market returns, employment growth, and innovation. If those giants start to falter because they can't monetize AI effectively, the ripple effects will be enormous. Pension funds that are heavily invested in tech stocks will see lower returns. Cities that depend on tech tax revenue will face budget shortfalls. Workers who've built careers in the US tech ecosystem may find their skills undervalued. In China, the opposite dynamic could play out. Successful AI commercialization could create millions of new jobs in AI services, data center operations, and application development. The Chinese consumer market could see an explosion of AI-enhanced products and services at prices that are actually affordable. This could boost domestic consumption and reduce China's dependence on export manufacturing, which has been a long-term strategic goal. The risk for the US is that we end up with what I call a moonshot without a rocket. We've invested in the Mission Control Center, the launch pad, the astronaut training program, but we can't actually get to the moon because we never figured out how to build a reliable rocket that pays for itself. The moonshot metaphor is appropriate because the original Apollo program was a government-led effort where cost wasn't the primary concern. But AI commercialization is a private sector endeavor. If it doesn't make money, it doesn't continue. So where does this leave us? What should we be watching for in the next 6 to 12 months that will tell us whether this trend is accelerating or reversing? First, I'm watching Q2 and Q3 earnings reports from US tech companies very closely. Not just the revenue numbers, but the forward guidance on AI monetization. If we continue to see vague promises about future potential without concrete revenue streams, that tells me the monetization gap is widening. If we start to see specific metrics on AI agent adoption, API call volumes, or application revenue, that might suggest companies are figuring it out. Second, I'm tracking chip export policy. If the US tightens restrictions further, that'll tell me Washington still believes the sanctions can work. If we see signs of loosening, that might indicate recognition that the strategy is backfiring on American companies. The specific language around what constitutes AI training versus AI inference will be legally technical but strategically crucial. Third, I'm monitoring power infrastructure developments in both countries. If China announces major new data center parks with dedicated power generation, that's a clear signal they're doubling down on their structural advantages. If the US starts fast-tracking permits for nuclear reactors specifically for AI data centers, that might show we're getting serious about our own constraints. My personal assessment is that we're at an inflection point. The narrative that the US is destined to win the AI race because we have better research institutions and more venture capital is starting to crack. The reality is more nuanced and depends heavily on how quickly each side can solve its core constraints. China needs to solve its semiconductor dependency. The US needs to solve its monetization and infrastructure constraints. Which challenge is more solvable? From where I sit, China's problem is technical. They need to improve manufacturing processes. That's hard, but it's engineering. The US problem is structural and economic. We need to rebuild our power grid, reorient our capital markets, and fundamentally change how we approach AI commercialization. That's institutional and political, which historically takes longer. But I'm also not certain about any of this. The pace of AI development is so rapid that a breakthrough on either side could change the equation overnight. A truly transformative AI application emerging from the US could justify all the investment. A Chinese semiconductor breakthrough could make export controls irrelevant. There's a lot of uncertainty here, and anyone telling you they know exactly how this plays out is either overconfident or selling something. What I keep coming back to is the Meta acquisition. That single deal, more than any statistic or policy paper, tells me that something fundamental has shifted. When one of America's most successful tech entrepreneurs decides he needs Chinese-founded technology to compete, it's a signal that the competitive landscape has changed. It's not about who has the best research lab anymore. It's about who can build products that people will actually pay for at scale. Whether this becomes a turning point where Chinese tech dominance becomes undeniable, or whether US companies figure out monetization in time, depends on a lot of moving pieces that we'll be watching closely. If you found this perspective useful, I'd appreciate it if you could hit the like button and subscribe. It helps this kind of in-depth analysis reach more people who are trying to understand these complex shifts. Share your thoughts in the comments. I'm particularly curious whether you think US sanctions are ultimately helping or hurting American companies. Thanks for watching, and I'll see you in the next one.